Good evening and welcome to Legacy Generation System live Wednesdays. It is November 5th, 2025. That's right, we are at the last 2 months of the year. And on today's live, we're going to be talking about leveraging debt to invest in assets. I'm going to be giving a short presentation just for mindset and understanding the difference between good debt and bad debt. Then after that, I'm going to transition into talking about the different types of loans that are available for you, including specifically today, we're going to focus on SBA 7A loans as well as 0% business credit cards. So without further ado, let's get right to it. If you are joining the live, please like, subscribe, and share. Please make sure you're commenting and asking questions. And if you watch this on the replay, same thing. Make sure you comment, like, subscribe, and share. And I'll go back, see the comment, and I'll answer your questions or do my best to get you the information you're asking for. All right. Without further ado, let's dive right on in. All right. Again, the topic for today is leveraging debt to invest in assets. Rich people use debt strategically to grow their wealth by purchasing assets that appreciate, like real estate, or to fund businesses that generate income. They also use it to maintain liquidity without selling investments, which can help them avoid taxes on capital gains and managed cash flow. This contrasts with bad debt, which is used to purchase depreciating assets or pay for consumption and can deplete finances. This is the fifth pillar of the legacy generation system: smart leverage and access, funding expansion without draining your system. Smart leverage is not about borrowing to survive, it's about borrowing to expand while ensuring your core wealth engine stays intact and keeps compounding. Key principles are: number one, access without liquidation. Instead of cashing out investments or your wealth reserve account, you borrow against them. This way, your principal continues compounding tax advantaged while you deploy the borrowed capital into revenue generating or appreciating assets. Number two, the dual capital strategy. Capital A is the money inside your wealth system: insurance, cash value, reserves, trust assets, always compounding. Capital B is the borrowed capital from credit lines or loans put to work for expansion. The result is you earn from both at the same time. Number three, the right type of debt. Focus on productive debt, generating income or assets, versus consumptive debt, which spends and disappears. Productive debt, for example, would be business expansion, cash flowing real estate, equipment that increases revenue, while consumptive debt would be luxury purchases that don't produce income. Number four, business and personal credit. Build strong business credit profiles to secure high limit, low rate financing without personal guarantees wherever possible. Maintain your personal credit health to keep consumer financing options open and cheap. Number five, control the flow. All borrowed funds should pass through your system, i.e., your wealth reserve account, before deployment. This ensures tracking, tax planning, and the ability to recapture interest. This is the legacy generation system. So now I'm going to go ahead and transition to start talking about, I just want to go and elaborate into a few things. First, let's quickly just touch on personal credit. You have to have good personal credit. Your personal credit must always be at least over 700 if you want to qualify for good business loans. There's a lot of lenders out there today that are selling loans and products that are going to be very expensive, that don't require you to have good credit. And unfortunately, most people are taking it, are getting taken for a ride with those loans, or I shouldn't even call them that. They're cash advances, and they're very expensive, anywhere from 30 to 50% over a 6 month period, and then 100 to 300% annually. And the reason why they're able to give it is because it's based on future receivables where your credit doesn't matter. So it's easy to get approved for funding, but fast and easy money is expensive money. If you want to get approved for good funding with low rates and good terms, then you have to have good personal credit. Everything from SBA 7A loans, 0% business credit cards, term loans and lines of credit, equipment financing, all of these types of funding for businesses require a strong personal credit profile and a good personal credit score, along with having business credit. So, having business credit does not disqualify or cancel out the need for good personal credit. It simply complements it and allows you to qualify where without the business credit you couldn't, but your personal credit still needs to be intact. So some of the things that may cause you to have a lower credit score: number one, of course, late payments, collections, charge-offs. These types of things are going to require credit repair, and I can get you in touch with a credit repair expert to clean up your credit, to help you to qualify for funding. But if you have clean credit, nothing derogatory, no late collections or charge-offs, then the reason that your credit might be low is because of high credit card utilization. Specifically, credit cards will reduce your credit score. Now, when you're looking at your credit report on most credit websites, they show you a overall utilization, and they'll tell you that your overall utilization is 20%. That's good, but you have to look at credit cards differently. The individual credit cards matter. So if you have 10 credit cards, 9 of them have a zero balance, but only one of them has a balance over 30%, 40 or 50%, even though your overall credit utilization may be under 20%, that one card with a high utilization is going to dramatically reduce your credit score. So what you need to do is you need to pay down that card, get the utilization to under 30%. Once that updates and reflects with the credit bureaus, you're going to see your scores jump dramatically. And of course, if you have more than one card that needs a balance pay down, then you're going to see an even more dramatic jump. So that's one reason you may have a lower credit score if you have good credit history with no blemishes and you have a good amount of history with depth and seasoning. That leads me to the other reason your credit may not be good. It could just be that you don't have depth and seasoning, meaning you have no lates, no collections, no charge offs. Your credit utilization and your balances are low, but you just don't have a lot of credit. You have maybe one or none, maybe none, zero credit cards or one. Maybe you have one loan. You don't have enough depth and history. An ideal credit profile would have 5 accounts, 2 to 3 credit cards with good credit history, nice big limits, good utilization on the credit profile, and then a loan and at least 2 loans, a car loan and maybe a mortgage or a student loan. The what builds your credit is having accounts with history. That's what builds your credit. So a lot of folks think that, oh, okay, as long as I don't hurt my credit, I'll have good credit. But unfortunately, when you go to apply for a loan or funding, you're going to get declined because you have no credit. Even though you have no bad credit, you have no good credit. So be proactive to start building your credit. There are several accounts that you can set up without a personal guarantee to start building credit on your personal credit profile. And that leads me to the other side of the situation, which is business credit. So your business credit is completely different than your personal credit. Your business credit is controlled by primarily 3 major bureaus: Dun& Bradstreet, Experian, and Equifax. Dun & Bradstreet has a Paydex score, so having a DUNS number means nothing. You have to build your Paydex score with transaction records, meaning you have to have accounts that report to Dun & Bradstreet. Then you have Equifax and you have Experian. Experian has a risk score and Equifax has an Intelli score. So those scores are going to report based on accounts that are reporting to those bureaus. Unfortunately, everything you do personally reports automatically to your personal credit, but not everything reports to your business credit. I've talked to business owners who've been around for 10, 15 years, who've had several business loans, credit cards, lines of credit, and none of them reported to the business credit. So building your business credit, it takes intention and a specific strategy, setting up your accounts with specific vendors and creditors that will report to Dun& and Bradstreet, Experian, and Equifax to build that report. The basis level is tier 1 business credit. It takes about 3 months to build so that you can qualify for most loans that require a business credit score. So that would include an SBA 7A loan up to $500,000. If you're looking to qualify for an SBA 7A loan and you've been in business for at least 2 years, you can get up to $500,000, and most likely you won't have to put any down payment on that loan. Now, if you're a startup, that's a complete different story. Startups, you have to anticipate at least a 20 to 30% down payment, unless it's an acquisition or you're buying into a franchise. And at that point, you could expect at least a 10% down payment for the loan. Having good personal credit with scores over 700, good depth and history, having good business credit if you've been in business for 2 years or more. As a startup, they wouldn't expect you to have business credit because you just got started. But you want to start building that business credit so that in 2 years you can expand and grow. And again, you'll have to have a business credit score. The score that they look at is called the SBSS score. It's basically the Small Business Scoring Service, which is data that's collected from the Small Business Financial Exchange. That data, Small Business Financial Exchange collects the data from Dun & Bradstreet, Experian, and Equifax, as well as your personal credit. They report that to the banks, to the SBA, and from that they formulate this SBSS score, which is pretty much 50% comprised of your personal credit and 50% of your business credit. So if you had, let's say, an 800 personal credit score, chances are your SBSS score, which is from 0 to 300, may be around 170 or 80. Most banks are looking for about a 170 score to qualify with the business credit. So if you have an 800 or higher personal credit score, you might not even need the business credit because your personal credit's so strong. But if you're even a 750, 770, even though that's a really, really good personal credit score, your business, your SBSS score may be right at around 155, 160, and the only way to build it up stronger is going to be to build that business credit profile. And again, that process can take 2 to 3 months. So you don't want to wait until you're applying for the loan to start building, because you're going to need to wait about 2 or 3 months to build that profile up so that you can qualify. So preparing in advance is going to be crucial to you being able to qualify and get the maximum funding when you need it without any delay. So that's the SBSS score. That's your business credit. When you start building your business credit, the first step is credibility. Credibility is how the banks and the creditors see you. This is basically what the banks and the creditors look at to define that you are a legitimate, credible business. I've created a masterclass that I've given away for free on my channel. I'll put a link to that masterclass in the description of this video later on after it's been recorded, so that you can access that masterclass for free. And it's going to give you all the instructions for credibility, as well as 3 to 4 tier 1 accounts that you can immediately implement to build your business credit. That's a free gift. Now, if you want one-on-one coaching, schedule a free 15-minute consult and we can discuss options. There's many different options depending on your needs, short-term and long-term. And so just schedule a free 15-minute call. Use the link in the description below. So let's go ahead and go back to talking a little bit about SBA 7A loans. And let's talk about, if you're looking to use the SBA 7A loan for a business acquisition, what are the preliminary documents that you need to get together so that the bank can at least review the documents, review your case, and determine if it's a loan that they want to offer you. So first of all, for you personally, we're going to need your driver's license, social security card. We're going to need your 3 years personal tax returns. We're going to need, if you have any business affiliations, a list of all your affiliations. If you have any personal debt, a list of that as well. Now, your resume is going to be important if you're a pure independent startup or an acquisition, or if it's a franchise. because they need to know who you are. What is your experience? You have to show them that the business that you're buying into is a business that you can manage, that you can run successfully because you have experience in that business. If you don't have experience in that business, then you have to be prepared to bring someone into the business as a manager or a key person who's going to help you run the business who does have that experience. Okay. So your resume is going to be important. You're going to need to come up with a business plan. And I have a link for a very, very affordable AI business plan that is SBA specific. It's only $15 a month to use this tool, and it builds a very professional business plan. But it's only as strong as what you put into it. So, what are they looking for? They want to know that you know your market. They want to know that you know your competition. You know your demographics. You know your costs, your expenses. What is it going to take to, stay up and running? They want to know that you've done your diligence and you're prepared to manage this business. And they want to know that you've mapped out your projections for the next 2 to 3 years, breaking down the next 2 years monthly. And don't be conservative about that. You can be conservative for your own personal, you know, I guess, view and perspective. But when you're presenting a case to the bank, don't hold back punches. Present to them the best case scenario of what that's going to look like. Okay. So your personal tax returns, your personal credit, of course, is going to be required. And with the banks I work with, I can collect that without an inquiry. So I can present your case without an application, get feedback, and let you know if it's a good fit, if the bank wants to do business with you. So if it's a business acquisition, you're going to need 3 years tax returns from the seller, at least 2 years minimum, but they really would prefer 3 years, including a year to date profit and loss statement and a balance sheet. So if you're buying an existing business, please keep in mind the SBA banks and the government, the SBA, they are not financing sinking ships. So you have to be buying a business that is showing growth year over year over year. It cannot be level, just balanced. It cannot have dips going down. It needs to be a consistent, showing consistent growth. This is not a loan for financing a sinking ship to buy out a business that's failing. This is a loan to buy a business that's successful, that you're going to take over and you're going to continue to grow and build that business. Okay. So again, you do have to anticipate a 10% down payment. This is called an equity injection into the loan, as well as another 6 to 12 months of reserves just for expenses and to cover yourself. They want to know that after that down payment, you're not completely tapped out. So you are going to have that. Now, you cannot borrow money to cover that down payment. If you are going to borrow money, let's say you're going to take a home equity line of credit or something like that to come up with that down payment, you have to be able to show that your existing personal income can service that debt, and it's not going to create an additional weight or risk on your business and the business loan. So as long as you can service that debt, if you're borrowing money to come up with that down payment or the reserves, and you can show that your finances currently can cover that debt and it's not going to require income from the business to cover that debt, then yes, that's okay. However, if that's not the case, then even if you're getting money from a friend or a family member as a loan, it would have to be a gift. They are going to have to sign a notarized document that that money is a gift and you don't have to pay it back to them. Now, you can also do what's called a self-directed 401k rollover. If you have a 401k or IRA that is not connected or in control of by an employer, which means that there is no custodian and you have the control over that 401k or IRA. A self-directed 401k rollover is basically rolling over the 401k or IRA into a new 401k, self-directing the investment into your own business. So the investment dollars land in your business account, and that's not debt. So you don't have to pay it back. There's no penalties. There's no taxes to pay. Because why? Because it's not debt. You're not withdrawing it. You're not liquidating it. You're simply rolling it over and investing it in your own business. So the same risk that you take when you invest in other businesses, you're taking in your own business. You're taking the risk on yourself, on your own business growth. SBA banks are completely okay with that because it's not debt. So you can use that as a bridge to come up with your down payment. You can use that as a bridge to, to come up with your reserves. And again, it's not debt. However, remember that 401k or IRA has to be free where it's not controlled by a custodian, which leads me to whether or not you should quit your job. And the answer is no. The bank and the SBA does not want you to start in a new venture, even if it's an acquisition or a franchise, and not have income coming in to support you as you transition into full-time business ownership. So let the bank tell you when they want you to transition into full-time ownership. So in the meantime, if you have a job and even if you're approved and you're qualified, don't quit your job. Let the bank tell you when they feel comfortable with you quitting the job and transitioning into full-time ownership. Okay, so these are some key clutch details that can make a difference in whether or not you get approved or declined along the way in the process. If there's going to be construction in the process, you can use an SBA 7A loan to buy commercial property as well as land and build on that land. You can buy existing commercial property and develop that property, create a new building or just renovate the property. Now, you cannot use this for investment property, but it has to be property that you're going to use for your own business. So instead of paying rent, you can just buy a building or buy an office, have your business operate out of that, and have the loan, instead of paying rent, pay the loan payment as your mortgage or your rent towards the business, and now you own an asset on top of owning the business. So I strongly recommend that. The requirement is that you occupy 51% of the loan. I'm sorry, of the business, of the building. So if you occupy at least 51%, the rest of it you can you can sublease it. So you can rent it out to tenants. And the in your business plan, you cannot show that you're relying on that income from tenants to pay for the loan. However, obviously, that's going to potentially be additional income that is going to perhaps service the entire debt. Imagine that. But again, in the business plan, that cannot be your strategy. They're not going to accept that. Okay. Um, But ultimately, whether it's buying a property, buying land, building on the land, or if you're renting, you can still do a leasehold improvement using the SBA loan, and that can also include furniture and fixtures and equipment with the SBA 7A loan. Now, very very important, you have to be able to get approved or even to get started. You have to show them that you have a construction offer, that you have a bid for construction. So that's going to cost you some money up front to get that quote for construction. If you're a construction person yourself, they're not going to let you do your own construction. So it has to be a third party. Um, with that, the construction costs are going to be very controlled. The bank is going to be paying the construction cost directly. It is very important, if you get approved for an SBA 7A loan and you have a closing date, that you don't get excited and let that construction company start before that loan closes. If they lay one brick, if they hammer one nail in on that property before you close that loan, it's over. The bank is going to cancel the loan. So it's very important that you do not let construction begin until that loan closes and you let the bank control the narrative of the construction. Okay? All right, so we talked about business acquisition. How about franchising? There's many franchise opportunities available. Again, a franchise is a 10% down payment. You can use an SBA 7A loan to purchase a franchise, because again, it's less risk because it has a model. It's something you can follow. And so whether it's an acquisition or a franchise, it's both 10% down. With a franchise, you're going to have to get the FDD, which is the franchise disclosure documents, and you're going to present all the same documents as previously listed. But with the franchise, they want to see that it's an established franchise with successful locations. So if it's a brand new franchise and they don't have many locations, that's basically considered a new franchise or an up and coming franchise, and chances of you getting approved for that is going to be very low. So they do prefer an established franchise. Now, do keep in mind, whether it's a franchise or an acquisition, the banks themselves are not required to participate on any loan, and they're in business for profit. So even though the government website, the SBA website, says that you can get a loan and they can be as low as 50,000. I don't have any banks, and I work with nationwide preferred lenders, over 20 banks. I'm always searching for new banks. I have no banks, and I don't think you're going to find any that are going to do a startup or an acquisition or a franchise that's going to be less than 150,000. And finding one that'll do 150,000, out of my 20, I may have one or two, maybe one or two. Most banks don't want to do less than 500. I do have a good handful, maybe four or five, that'll do 350,000. But most banks, they're stopping at 500. They're not even interested in going lower, because here's the thing: if they do a loan for 150,000 or they do a loan for 1.5 million, it's the same amount of work for the bank. So why are they going to spend time on smaller loans doing the same amount of work for less profit? So it's at their discretion. So the challenge when you walk into a bank directly is that, first of all, they might not be participating. They might not like your industry. They may have a higher criteria for credit or for down payment, because it's not cookie cutter. The challenge is that the SBA, which is a branch of the government, Small Business Administration, they created this program, the SBA loan, but the bank is the lender, right? So one of the guidelines that the SBA set is that the bank can implement their own guidelines above and beyond the SBA. So as long as they meet the SBA guidelines, the bank has its own guidelines. And therefore, if you go to some of the big banks, you're going to find that they don't even finance. They won't do a startup. They won't do acquisition. They won't even do franchises. They don't do any of that. They want to see 2 years tax returns. And unfortunately, the way they'll say no to you is that you're just not qualified for SBA. And if you didn't know any better, you just assume I'm not qualified and you give up. And so unfortunately, that's what a lot of people get. And the truth is, you talking to the wrong bank. And that's why you want to work with me. Because again, I work with over 20 nationwide preferred banks and lenders, and they operate at all levels in every industry, from the smallest loan to the biggest loan, which is up to 5 million. And I have banks that will do the 504 loan. We can go up to 25 million on commercial property, and the terms can be up to 25 years. And so uh, the difference is that I can package your loan, present it to the banks that I work with without an application, without an inquiry on your credit, and within 2 to 3 business days, I can get feedback whether or not if they want to participate or if they want to give you an offer. 90% of the time, 99% of the time, if a bank says yes at that stage, as long as everything else checks out as we go through underwriting, you're going to get approved. But if they don't like what they see, they're going to tell me whatever they don't like. And that's great, valuable information that I can take to the next bank and put that on the table. And just because Bank A didn't like it doesn't mean Bank B won't. I have many cases where I had to go to 2 or 3 banks until I found the right bank for that specific unique circumstance. So these are some of the challenges with the SBA 7A loan. I hope that this has really helped you if you're in the market for an SBA loan and you're looking to figure out how to package the loan. What details do you need? Again, franchising, acquisition, they love it. If you're a startup, they'll do it too, but you have to be able to really sell that startup. You have to show real strength in assets as well. They're going to probably want more collateral if you're a pure startup, bigger down payment. So it's going to be a lot tougher as a pure independent startup, but it is doable. One thing that is unfortunate, as of June this year, 2025, is that you can no longer refinance merchant cash advance debt with an SBA 7A loan. I refinanced a merchant cash advance about 2 years ago, maybe 2 or 3 years ago, that was over $3 million in cash advance debt with an SBA 7A loan. And this changed everything for her business. This client was able to expand and grow from 10, I think she had 10 locations. Now she has about 25. And so without that, she was going to actually have to file bankruptcy because the cash advances were completely choking out her business. She had no cash flow to make payroll. But that's no longer available. So that's unfortunate. Now, if you do have cash advances, there are other ways and strategies that I can help you with to get out of that debt. But unfortunately, it's just not going to be an SBA loan. Alrighty, so moving on, let's talk about business credit cards and getting approved for 0% business credit cards. Very simple, guys. Need to have credit scores north of 750. Again, if you have scores lower, it's probably because of high credit utilization. Anyone who tells you 680 or 700, they're blowing smoke. They're basically trying to get you to commit, pay them upfront fees, and then later they're going to tell you that, yeah, you have to pay down and repair, and they'll keep you in their repair program for 6 to 12 months before you can qualify for funding. I'm not going to play that game with you. I'm just going to tell you straight up, if you're looking to get approved for 0% credit cards, that could be anywhere from $20,000 up to $200,000 of 0% interest for 12 to 24 months. You have to have good, excellent personal credit. 750 or higher, closer to 800. Your credit utilization needs to be under 10%. I'm talking about personal credit. You also need to have excellent business credit, at least tier 1 business credit with an 80 or higher Paydex score, an 80 or higher Intelli score, and a very strong risk score. So with that said, if you have the business credit and the personal credit, one of the things that you're going to need to do is you're going to need to establish a relationship with the key banks that you want to get approved for. You can go ahead and just apply, but you're going to get a small approval. And then in a year or two, you can request an increase and see a huge increase. Or you can establish the relationship up front, and instead of trying to rush the process, give it a month or two to season that relationship, meaning you deposit some money in the bank, you show them that you're a good client, and then you apply for their credit card. So it's going to take about 2 to 3 months to build the business credit. Perfect timing. In that time, you make those deposits, let them season for 2 to 3 months. By the time the business credit is ready, your 3 or 4 banks that we're going to be getting approved with have some seasoned history. And now when you apply, you can get approved for the maximum approvals all the way up to 200,000 of 0% interest business credit cards. They are going to be looking for you to verify income. So they are going to be asking about personal income and business revenue. At no point in time do I ever recommend anyone lie and tell them that you have income and revenue that you don't have. So if you have good income and you have good revenue, then you can get big approvals. If you have lower income and lower revenue, you can still get good approvals, but just not as big. And so just keep that in mind as well. Anyone who's telling you to lie and mislead the banks, do that at your own risk. All right. Well, I hope that this video was of value to you. I hope that this live gave you some real tips and tricks to improve your credit, personal, business, get access to funding with the SBA 7A with 0% business credit cards. You can schedule a free consult with me. I'm happy to help you to package your loan, happy to help you with 0% business credit card funding, equipment financing, asset-based lending, term loans, lines of credit, all these different financing solutions for your business. And of course, with the legacy generation system, as we started, we want to start off by building and establishing our wealth reserve account, which is pillar number 2, funding and building our own bank. And then all of the debt, the loans and lines of credit that we get, we want to funnel it through our bank so that we can recapture that interest and have it grow for the rest of our life. And that's the goal. And in due time, by building that wealth reserve account and creating your own bank, you'll never have to borrow from another bank ever again. If this video is of value, please like, subscribe, and share. Let someone know who will let someone know about my my classes, my instructions. Check out legacygenerationsystem.com. You can check me out at theapprovedguy.com. I look forward to working with you. God bless and take great care.